if I had to guess, I would say maybe a year, 18 months, 2 years max. And at some point, there will be no more secondary silver available. Someone's going to stand for delivery on a futures contract, and they'll be told, sorry, we can't deliver. We're going to have to, force majeure or something. We're going to have to pay you out cash. And so that's when I think that the entire sector is going to wake up in a big way. It could, I'm not saying silver can't rally for different reasons before that, but that kind of event would be a major shock to the industry. Like I could get to see silver spike $10, $15 almost on an overnight basis.
According to the Silver Institute, the silver market is expected to maintain a deficit in 2024, marking the fourth consecutive year of structural market imbalance. Despite a projected 9% reduction in the deficit compared to 2023, the deficit is still anticipated to be notably high by historical standards, totaling 176 million ounces. PeterKrauth, offering insights from Silver Stock Investor, delves into the persistent disparity between silver supply and demand. Over the past 4 years, the silver market has experienced significant deficits, exceeding 600 million ounces, representing approximately 60% of a single year's supply. The Silver Institute highlights a decline in total silver supply attributed to production disruptions at key mines such as Penasquito. However, non-investment demand has surged to record levels, primarily driven by robust industrial demand, particularly for photovoltaic solar cells. Although there have been slight decreases in demand for jewelry and silverware, industrial usage remains strong. A significant development has occurred in the Comex silver vault totals, where registered silver has increased by 25.8 thousand ounces. However, what's concerning is that open interest now surpasses 265% of all vaulted silver, and a staggering 1,560% of registered silver. Krauth highlights the worrying trend of diminishing the number of registered silver available for exchange delivery. This indicates a heavy dependence on secondary supply by industrial consumers. If this trend persists, it could eventually lead to complete depletion, potentially causing a sudden price surge of $10 to $15 per ounce. Join us as we delve into PeterKrauth's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
We've had, as you mentioned, 4 years consecutively of deficits. And if you add up the 4 years, right, something like more than 600 million ounces of silver in these 4 years in deficit, which is about 60% of a single year's supply. And yet silver price has gone sideways for about 3 years. And so you have to ask yourself, well, how and why is that happened here? And sort of for your viewers to understand a little bit, you've got sort of 3 aspects to this. You've got industrial demand, where industrial supply, this goes to users that make solar panels, that do the electronics, all sorts of things like that. You've got the investment side of it, so people were actually buying physical coins and silver. And then you've got sort of this area where when there is oversupply in a given year, that gets shunted into the inventories of things like the futures exchanges, ETFs, for example. And so I believe what's been happening is that in the last 3 years, and when you look at the inventories in these exchanges, the major exchanges are the Comex, the LBMA, and Shanghai. And so when you look at the inventories in these exchanges, now first let's look at overall inventories, and because there are categories. Overall inventories are down about 30 to 40%, which is really quite impressive enough on its own. So silver has been drained out of these inventories. I call them secondary inventories. Now, when you look at these exchanges, they've got what we call registered inventories, and it's actually the registered inventories that are the ones that are available for delivery. So here's my take. I believe that you have numerous industrial consumers buying long futures contracts and or buying silver ETFs, and then asking for delivery. When the futures contracts mature, they can stand for delivery, and they're saying, thank you very much. Now that my contract has expired, here's where I want it delivered. I'll pay the fees. I'm happy to take it. And they get silver at almost spot price. And then you have the ETFs, for example, where they could be buying the ETF, and oftentimes the bar is pretty high. You might have to say at least $1 million or more units in this ETF. That's obviously not a problem for a lot of these large consumers. So they can buy the ETF and ask for physical metal at any point in time. It might take a few weeks or a month and they'll get their delivery. Right. So I think that, oh, by the way, the registered silver, so the silver that's actually available for delivery in these exchanges is down about 70% over the last 3 or 4 years. So what's available for delivery is down more than the same overall on these exchanges. I believe that's where they've been getting silver for the last few years to meet that demand. Nobody knows exactly how much of this. You can look at what the exchanges have. Beyond that, there are probably inventories. You could consider some privately owned silver in bars and anything else that people will sell at higher prices. But you have to believe that is access to this kind of secondary supply and inventory is only going to last so long. If I had to guess, I would say maybe a year, 18 months, 2 years max. And at some point, there will be no more secondary silver available. Someone's going to stand for delivery on a futures contract, and they'll be told, "Sorry, we can't deliver. We're going to have to, force majeure or something. We're going to have to pay you out cash." And so that's when I think that the entire sector is going to wake up in a big way. It could, I'm not saying silver can't rally for different reasons before that, but that kind of event would be a major shock to the industry. Like I could get to see silver spike $10, $15 almost on an overnight basis.
Amid widespread anticipation of the Federal Reserve's decision on its benchmark interest rate, Chair Jerome Powell and his colleagues will likely maintain the rate unchanged for the 5th consecutive time during their meeting. This cautious approach signals the Fed's need for further evidence of sustained inflation before considering any rate adjustments. According to Krauth, changes in interest rates, particularly decisions by the Federal Reserve, can significantly impact gold and silver prices. Gold often performs strongly when interest rates peak, even before actual rate cuts occur. However, silver prices experienced a pullback at the beginning of the week, trading in the mid-$25 range after nearing the upper boundary of a long-term range. This correction could be attributed to shifting expectations regarding the future trajectory of interest rates, which are now anticipated to remain elevated for an extended period in the U.S. Krauth notes that silver typically takes some time to react to changes in interest rates, particularly rate cuts. Its rally may not commence until after rate cuts have been initiated. Let's get back to the interview.
Silver follows gold. I don't think that's going to change a whole lot. What we've been saying, a lot of people who follow this space have been saying that silver is likely, or gold is likely to move when the Fed. Gold's held up because rates have not been hiked anymore. So we've probably reached a plateau. So silver's held up because gold isn't that. It's likely that gold start to run when we start to get around. The market sniffs out that we're getting rate hikes. Silver tends to follow. I expect it will follow with a lag. If there's a black swan, that may be out the window completely, and silver could just run with gold and spike at the same time. But if it follows sort of the normal pattern, it waits for gold to run, and gold runs because of rate cuts. So I would see silver maybe only really starting to move later in the year. What I do want to point out, and I have this in my presentation as well, and I looked at what inspired me was I looked at a chart of gold and how gold does during rate cutting cycles, a peak in rates and then cutting cycles. And actually, if you look at gold, the moment rates peak, it actually starts to do well when rates peak. You don't even have to wait for the cuts to part. So the lag in silver is that silver starts to run once they've started cutting rates. So it takes a little bit longer. And I looked at in the last 3 rate cutting cycles, I started counting from the time silver started to move up. And it was about halfway through the rate cutting cycle. What astounded me was that if you looked at just the average of the last 3 rate cutting cycles and you waited for silver to start to go, it was actually up on average 413%. So there's a lot to look forward to when, and assuming history repeats, there's a lot to look forward to in silver when the trade actually does start printing rates. Investment demand was outsized because India had underinvested for a couple of years after COVID. Had actually overinvested after COVID, and then pared back for a year, and then that I believe, is likely to come back. So I think that it's going to probably end up being an underestimate as well in terms of what's going to drive what final numbers are going to be like for investment demand, and what will drive that. And then when you talk about industrial demand, I think that, so it's interesting to note that if you just, let's look at solar in particular, solar was about 100 million ounces 4 years ago. It was 190 million ounces last year. Silver forecasts over 200 million ounces next year. And so that's more than a doubling in 4 years. It's tremendous. And the demand for solar has become something like 20% of all industrial demand. It's now 30% of industrial demand. Industrial demand has grown to over 600 million ounces a year. And so solar now represents almost 20% of every ounce of supply every year. That's why I say it's the 800-pound gorilla in the silver space.
Silver is presently considered undervalued compared to gold. While gold is typically the preferred safe haven asset for institutions, retail investors often gravitate towards silver due to its perceived affordability. Additionally, the industrial demand for silver may hinder its performance if demand has been relatively subdued earlier in the year. Based on the current dynamics in the silver market, what strategies do you think investors should consider to navigate the ongoing deficit and potential price surges in silver? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.